Namaste. As I've always been doing all these years, at the end of the financial year, at the beginning of the financial year, this time too we thought we will communicate how the year has gone by and how probably the year will look like. Clearly, the last such sessions when I had exactly the same time of last year, all of us are getting worried about the lockdown announcement, how the economy is going to shape up, whether at all economy will come back to normal, and many question marks were in my mind. At the same time, the fear factor was the highest, creating a panic in the market, and huge amount of fall that we saw between the period of March and April, and even continued up to an extent in the month of May. And then post that, market of course got stabilized. Clearly, the revival was on the back of one, hope coming back, optimism coming back, on the basis of the regulators coming with many measures that could boost the confidence of market players, companies, corporates, and many such intermediaries in the market, and therefore the confidence got returned. And that's why if you look back, you can't even imagine the kind of situation in which we were in. The way the market has bounced back is something is amazing, how a power of regulator can actually play a role. One of my biggest learning of last year, whenever the regulator understands the depth of the problem, and they also understand the need for their support that needs to be given, if that is underestimated, then definitely we may probably get it wrong. And that's something I think was the biggest lesson learned last year. But don't ever underestimate the power of regulator. And if you again look back, various sectors which are of course languishing for a many number of years also got pulled up in the same period, especially around the Make in India theme, especially on the manufacturing sector it got revived. The auto sector sentiment got revived. IT as a sector, just for a few days back when I looked at just a simple 1 year index return of IT as an index, had almost given about 100% return, thanks to the way the technology is being used globally, and they played a role in making people to work from home using technology. So for technology as a sector also did exceedingly well. Banking financial sectors initially of course had its own tough time. At the end of the day, whatever money has been given to the borrowers has to come back. There was a fear, but again thanks to the government of India for giving a guarantee for all such lending the banks are doing to MSMEs, boosted the confidence of bankers to go and lend money back. Therefore, I see it actually is something bringing back the credit confidence, bringing on the money on the rotation. All such things actually have enabled the confidence to return in the market as well as in the various sectors, and therefore creating a hope for a sharp recovery that can be seen in the next few years. Having said that, clearly we are now reaching a stage, markets have reached the all-time high. Of course, from the all-time high in the recent past has given a correction, largely on the back of flows, also on the back of fear now that's emerging on interest rates to go up, both in India as well as globally, on the back of increased fiscal spending by the respective government, both in India and abroad. This also gets of course combined with the fear of commodity prices going up, such an oil price has gone up recently, copper and other commodity prices have gone up. For many industries are now seeing an input cost going up. So therefore there is a fear that it will also lead to an inflation going up. So therefore there is an argument going on that interest rates may be hiked. But one thing of course has been reiterated by the regulators globally as well as in India, while there is a merit for the interest rates to be considered for hiking, at the same time there is also merit that interest rate to be kept stable for a prolonged period of time till such time we see growth come back and sustains, inflation stabilizes, and the corporate earnings come back, and employment job market actually picks up. When all such indicators starts coming in, which probably would take about another 1.5 years. Therefore, the fear of interest rates going up may remain in the minds of people, but in reality, the interest rates may or may not go up as much as what people fear. At the same time, maybe it's creating a ground for next 2.5 years, the interest rate to be hiked. Some probability would emerge as we start seeing some of those milestones, or maybe some of those parameters which the regulators will start looking at. At the same time, the corporate earnings have already started picking up, and that's also something, in my view, the markets already discounted the improvement in the corporate earnings. At the same time, a continuous improvement in the corporate earnings will come back as the economic rate will come back. Probably the market, the hope is drive the market, then the earnings come back, the market goes to a stability, then the optimism returns, then the earnings growth come back and P multiple expands. That's a cycle in which the market always moves. Therefore, we are as an investors have to understand the cycles and keep the confidence that in the long run, Indian equity market will do well. In general, equity market will do well. In the long run, of course, India as a country will do well compared to most of the other markets. Also, one has to remember, India as a country also being now increasingly higher recognition from global investors to consider as part of their investment allocations into India. Therefore, there is already a prediction the next 10 years emerging market would return big time, and low interest rates prevailing for a long period of time, recovery in the real estate sectors in terms of consumers coming back and buying real estate assets. Therefore, the whole cycle returns to normal. Consumer spending also may start getting better as the lockdown period gets reduced significantly. Sorry, not a lockdown period. The general fear of sitting at home, not moving out, and that also will probably change maybe in the next financial year 2021-22, and such activities returning, we'll have to probably expect the overall momentum that could continue and even go up as we move forward. That hope I think one has to keep. That's something as a money management business we have to of course play with the element of expectations and hope, as well as the reality check that we have to keep doing it, on the basis of which I feel that as an investor, I think one has to look at investing for the long term. As a fund house, I must take pride in telling all of our investors that we as a fund house crossed 2,70,000 crores assets under management. Our equity assets under management crossed 2 lakh crore, and overall customer base continued to remain about 71 lakh customer base spread across the country, and many distributors who of course have been dealing with us in getting the investor money, and many investors who are of course dealing with us as a fund house who's now completed 26 years of presence in the Indian mutual industry, also now gaining more and more confidence and expressing their happiness, which of course comes in the form of an NPS score during the COVID period has gone up. That I would assume is the result of what our team across the board would have got engaged with each one of you in some form or other and connected with you in some form or other, giving us an input on what we are doing as a fund house and how we are actually looking at the investment world in general, and sharing such kind of things also gives me some kind of happiness for having been one of the largest mutual fund serving the nation's interest and channelizing the public savings in the mutual funds. Through the same period, of course, in general there is a fear. Our job is actually over the period of fear to handle the people, and that's something which I again repeatedly do our communications on SIPs, that how it is important to hold on and how it is important to continue, and how SIPs by continuing for long term can serve the needs of every customer for which you have come into SIP as an investment as a concept. As you all know, that SIP is being made for some purpose, there is a goal, and there is a period for which make investment. Therefore, we kept communicating all the investors who are afraid of continuing the SIPs. We said that we must continue the SIPs because we have come with the purpose and the goal. Till such time the goals are not being met, SIP is something that has to continue. I am quite happy to share with you the last 2-3 months, SIP is an asset class now coming back in the radar of the investors. I would assume 2021, 22 and beyond, SIP I think would come back big time. That's something as a fund house we continue to focus. And last, of course, in the least, clearly while managing money, it's not just about return is very important. It's of course important, no doubt. At the same time, how the money is being managed in the form of controlling the risk associated with such investment, risk associated while dealing with investors and protecting there is no fraud that happens in any of the customers' account and that remain safe. At the same time, when you manage the money, whether it is in fixed income, investing in various companies in the form of lending, or various companies in the form of an equity, we must ensure that we pay a lot of attention to the risk associated with such investment, as well as the governance that we have to keep. I think we as a fund house have given utmost priority in managing the risk associated with all such investments of yours with ABSLMC mutual fund. That's something I thought I must mention to you, that while managing the portfolio for generating return, the equal amount of emphasis is also given on risk management, which ensuring a longer term delivery, more sustainable as well as more satisfactory. And as we embark in the new journey, the year 2021, 22, starting from April, clearly the overall investment principle I think has to remain more or less the same. Focus on asset allocation and focus on product that takes care of the various needs of the investors, which takes into account the savings needs, the income needs, and wealth needs, and taxation needs. In fact, we as mutual funds are providing a solution for every needs of yours in the form of offering 4 different type of products and each of these categories, and that ultimately forms part of the asset allocation that one has to have. I continue to believe that mutual fund can become a single platform for all your investment needs by focusing on asset allocations and focusing on the various purpose for which you are making the investment by choosing the right product in each of the segment. Second, of course, as a fund house, while we have actively managed funds in each of these categories which I talked about, definitely we also are introducing 2 different set of category of product. Is an asset allocation fund, which is nothing but invest as you are investing into various category of mutual funds, and that's something we as a fund house will identify the opportunity that exists at ongoing point of time. Every month we of course will do the rebalancing of the schemes by choosing the funds from one to others, from large cap to mid cap to large cap, and so on and so forth, or maybe equity to fixed income. Such asset allocations will do it dynamically, keeping in mind the view that emerges at every point of time. That's something we as a fund house going to have high focus in the coming financial year. At the same time, we are also introducing ETF, which is of course low cost product. My own belief is ETF as an asset class will remain complementary to the existing product. Therefore, that's something also we want to keep it as part of the overall strategy for the year 21-22. At the same time, ETF also will find its own allocation, the asset allocation fund, depending upon which segment of the market we are investing with your money into various asset classes. The ETF also will figure in the asset allocation fund. That's something as a fund house we do have very clear view. At the same time, within the fixed income space, we believe that interest rates, fear of going up, it stays, but at the same time it's not going to go up in the next 1.5 years time frame. Therefore, investors can park themselves into short duration funds for managing their short-term surpluses of money that they have, or at the same time any fixed income alternates if they are looking at in the mutual funds can potentially find its way into the short or low duration funds as part of their investments, and then worry about reinvestment risk after say 2 years or 1.5 years when the interest rates either starts going up, or maybe after assessing after 1.5 years how the interest rate is going to move, and then decide the allocation to our fixed income in the long term. So this is the broad principle on which we are planning our strategy for 21-22, and I thought it will be useful for you to decide on your investment, or maybe useful for you to advise your customers on the basis of what I just mentioned about, in addition to but you may have your own views on the basis of the information that is available in the public domain, as well as various input that is coming in for you to consider taking your investment decision. Thanks to all of you for showing your confidence and your association with Personal Life Mutual Fund, and hope to again engage in a similar format in the year 21-22. I am also sure that 21-22 and beyond, your investments will deliver your required outcome or desired outcome over a period of time dealing with the Personal Life Mutual Fund. Thank you once again.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.